Adjustments. You have learned how income impacts a tax return, but now we're going to talk about how that income can be reduced, and that's generally through adjustments and deductions, which results in either a larger refund or a lower tax bill. Now, adjustments can be found on 1040 Schedule 1, Part 2. Adjustments are deducted from total income to arrive at adjusted gross income, resulting in either a larger refund or less tax due. This next slide shows you the typical adjustments that we see at the VITA sites. The first one is the educator expense, and we're going to talk about these in detail. Health savings account, Form 8889, self-employed health insurance, penalty on early withdrawal of savings of CD, alimony paid, IRA deduction, student loan interest, and other adjustments. And this chart can be found in the 4012, page E1. Again, part 2 of the 1040 Schedule 2 shows the adjustments that I just mentioned. Typically, you will add up all of these adjustments, and the total will then be carried to Form 1040, line 10. The first expense that we will talk about is the educator expense. What is the maximum benefit? $250 or $500 if married filing jointly can be deducted. Who can claim the expense? Eligible educators. An eligible educator is a kindergarten through grade 12 teacher, instructor, counselor, principal, or aide who worked in a school for at least 900 hours during a school year. What are the qualifying expenses? They include expenses that are ordinary and necessary. Such as books, supplies, equipment, including software, other materials used in the classroom. Additional professional development expenses are allowed unless reimbursement is offered by the school but not accepted. What are non-qualifying expenses? Expenses for homeschooling or non-athletic supplies for courses in health or physical education. What other issues apply? Taxpayers must reduce qualified expenses by any of those listed there. In addition, expenses related to COVID, disinfectant, all of those can now be included in that educator expense. Another adjustment that we'll take a look at is the self-employment tax. As we mentioned earlier, self-employed individuals are not covered by withholdings as employees are. So they have to pay what we call a self-employment tax. And they can deduct a portion of their self-employment tax from their income And you don't have to worry about this because TaxSlayer will automatically compute that amount based on the business income that's completed correctly. This screenshot shows you a snapshot of how the self-employed insurance deduction is listed on the tax return. And nowhere is inputting the correct information, taxpayer will automatically compute this. But we do want to caution you to not enter it again if you already took it as a Schedule C business income expense. The next adjustment that we would like to talk about is the early withdrawal penalty. You may have seen this, we mentioned it previously when we were talking about income that has to be reported. And that generally shows up in on line 2 of the 1099 INT. Another adjustment that we'd like to talk about is alimony. Typically, Texas does not have alimony, but we have a lot of taxpayers that have come from other states. And you may run into this at a VITA site. But payments are defined as alimony if all of the following are true. Payments are required by a divorce or separation instrument. Payer and recipient spouse don't file a joint return with each other. Payment is in cash or cash equivalent, including checks or money orders. Payments isn't designated in the instrument as not alimony. Spouses legally separated under a decree of divorce or separate maintenance aren't members of the same household. Payments aren't required after death of the recipient spouse. Payment isn't treated as child support. Now, these payments are deductible by the payer and must be included in income by the recipient. And on the Schedule 1 for adjustments, you will see a line for the actual alimony, and that is line 19A. And you will notice that you have to enter the recipient's social security number and or the date of original divorce or separate maintenance agreement. You can also take an adjustment for a traditional IRA deduction. And for traditional IRAs and not Roth IRAs, taxpayers may be able to deduct some of or all of their contributions to the IRA, depending on circumstances. General amounts in an IRA, including earnings and gains, are not taxed until distributed. Contributions may be eligible for the retirement savings contribution credit as well, and we're going to talk about this a little later. Individuals must have taxable compensation. Contribution must be made by the due date of the return, no extension. Deduction, the lesser of contributions or compensation, no age limit. Now, there are maximum contribution amounts, and they are $6,000 if under 50 and $7,000 if 50 or older. Now, compensation would include self-employment income, commissions, taxable alimony, or taxable scholarships or fellowships, and we'll talk about that a little later. Excuse me. And as I indicated, these are listed on Schedule 1, line 20. There also could be an adjustment for a health savings account. A health savings account is a tax-exempt trust or custodial account that a taxpayer sets up with a qualified SHA trustee. Distributions from an HSA are non-taxable if the funds are used for qualified medical expenses. A taxpayer must be an eligible individual to qualify to contribute to an HSA. And these are some of the other stipulations that are required. The adjustments for the health savings account would be listed on a form 10. Would be listed on a form 5498 SA, and it would be box 2. And you would also see SHA under box 6 checked. Contributions can be made by an individual employer, family members, or other individuals. Employee contributions are often noted on a W-2, box 12, and you'll see a code W. This also includes amounts that was contributed by the employee through a cafeteria plan. Contributions to an employee's account through a Section 125 cafeteria plan are treated as employer contributions, and they aren't deductible. So this is what that form looks like. And the adjustment for a health savings account would be listed on line 13 of the Schedule 1. And this is what a snapshot of what the tax layer input information would look like. And you can find this on 4012, page E7. And for 2021, we see a note of contribution limits. Family plan, $7,200, self-only, $3,600, and $1,000 if the owner is age 55 or over at the end of the year. And again, this can be found on page E7 of the 4012. Here you see a form 1099 SA, and you would see amounts listed in box 1, box 3, and 8 checked. Box 5 SHA checked. This is a screenshot of how the SHA distribution amount would be listed, and this can be found on E-8 of the 4012. The next deduction that we would like to discuss is the student loan interest. And this deduction is found on Schedule 1, Part 2, line 21. But there are some limitations. The maximum benefit is $2,500. And there are some loan qualifications. Taxpayer must be legally liable for the loan, must have been taken out solely to pay education expenses, and can't be from a related person or made under a qualified employer plan. Student qualifications. The student must be you, your spouse, or a person who was your dependent when you took out the loan, or would have been your dependent, except you were a dependent or had gross income over the exemption amount or married filing joint. Enrolled at least half-time in a program leading to a degree, certificate, or other recognized educational credit. And generally we say a semester is considered as half-time. There is the time limit on the deduction. You can deduct interest paid during the remaining period of your student loan. And there is a phase-out amount. The amount of your deduction depends on your modified adjusted gross income and filing status. But no worries, tax layer will take this into consideration once the information is input. And again, this information can be found in your 4012 on page E-11. The form listed here is a 1098E, and this is the form that the lender provides to the taxpayer. And information will be listed in box 1. We're now ready for a poll question. Poll question number 23. Stan, an unmarried college student, working part-time, earned $4,500 during the tax year. What is the maximum he can contribute to an IRA? You'll have a minute to complete the poll question. Okay, we will end the poll. And let's see, how did we do? I'll lunch the results. 74% of you got that correct. The correct answer is $4,500. The answer is listed here. The next poll question Number 24, Bob and Carol are married and both are 55 years old. They both work and each has a traditional IRA. During the tax year, Bob earned $2,000 and Carol earned $50,000. If they file a joint return, what is the maximum amount that Bob can contribute to the IRA? Oh, you'll have a minute to answer that question. Okay, we'll go ahead and end the poll. And I'll share the results. We didn't do too well on the responses. And let me explain it a little bit more. The reason the answer is $7,000 is because they both are over 50, and the maximum amount that they can contribute with that stipulation is $7,000, and their earned income was over that amount. Okay? And the answer is displayed.